So it's summer. The 4th of July is next week, and Americans are in full summer travel mode. Our family has driven from Des Moines, Iowa to Breckenridge, Colorado almost every summer for the past 20 years, 747 long miles. One feature of summer car travel is the dreaded road construction areas, miles of single-lane traffic on the interstate, slowing things way down. You know, the economy and markets are a little bit like summer car travel. Markets and economies have sporadic cycles, and as much as we wish for simple, steady growth, the world has never really worked that way. We're getting a lot of questions recently about bear markets and recessions and whether one predicts anything about the other. Bear markets are slowdowns when U.S. stocks fall below 20% or more, and they've now occurred 13 times since 1946, about once every 5 to 6 years. But even though they're recurring, they vary greatly in length, in depth, and in the space in between. The most recent bear market before this one, during the pandemic of 2020, reached its low point in a record 1 month. The bear market of 2007 to 2009 was a protracted one, taking almost 54 months to get from one peak to the next. Most of the time, we're not in a bear market. Most of the time, investors are actually seeing positive growth in their portfolios. Like bear markets, with all the talk about a possible recession, it can be helpful to look at a bit of history. From 1945 to 2020, the U.S. economy had seen 12 recessions lasting an average of just over 10 months and expansions lasting an average of just over 64 months. Here's an important point, though. The economy is not the same as the stock market. They're related, but not identical. There are correlations between recessions and bear markets and vice versa, but not clear causation. You can't predict what one will mean for the other. Just look at the date ranges on this table. 6 times bear markets for stocks anticipated recessions. That's the blue. 2 times a bear market followed the start of a recession. That's the red dates. 3 recessions didn't see an overlapping bear market at all, and 2 bear markets didn't see an overlapping recession at all. So while we're not officially in a recession yet, we have entered a bear market with the S&P down by as much as 23% before last week's recovery. Whether that will prove to be the bottom after 6 months is anyone's guess. Whether it leads to a recession or not is also anyone's guess. What does this all mean for investors? Well, for long-term investors, we think it's interesting information that should not deter diversified investors from being optimistic about the longer-term future for both the U.S. economy and the U.S. stock market and global markets as well. This chart simply shows the growth of the S&P 500 from 1950 through Friday. The gray bars are the recessions, and you can see the volatility of the stock market, the purple line around those recessions. When a total portfolio is constructed such that an investor never finds themselves having to sell stocks during bear markets, that investor benefits from the uninterrupted compound growth of being a long-term investor, staying invested through recessions, through bear markets, expansions, contractions, all different kinds of political environments. I wish there was a sign saying how much more market and economic construction we must go through before it's over. But like our summer drive to Colorado, we'll keep going, knowing that the lane closures will ultimately end, the flow of traffic will speed back up, and will allow us to get to our destination. So for investors, be diversified, stay invested, and try to enjoy the trip.